Hello, everyone. Thank you for sticking around. I know it's been a bit of a long day. Thank you very much for joining me for this panel. So the topic of the day is ensuring market integrity and addressing greenwashing concerns. And I'm very delighted to welcome quite a rich panel with on the line Julie Becker, CEO of the Luxembourg Stock Exchange, as well as Nicole, Della, Vedova, Head of Corporate Finance at ENEL Group. Hello, both of you. Can you hear us properly?
Hello.
Hi.
Yes.
Perfect.
Good afternoon, all.
And we also have on stage Bram, Managing Director, Goldman Sachs Asset Management, Cedric Rimaud, Senior Credit Analyst, Asia Pacific for Anthropocene Fixed Income Institute, Christa Clapp, Managing Director, Sustainable Finance, Shades of Green, now part of S&P Global, and last but not least, Rahul Ghosh, Managing Director, Sustainable Finance for Moody's Investors. All right. So thank you to all of you, because I know it's both a complicated and very topical subject. I'm going to start with a very simple question: what are we talking about? And I think that is the core of the question, which is how do we draw lines between the notions of integrity, greenwashing, and I would add level of ambition, level of quality, additionality, which I put in all. They're very, very, very often mixed, and I think we need to put a bit of order in this. So, who wants? I'd love to hear all of you on it. So, who wants to go first? Go ahead.
I'm happy to start. Orith, that's a lot of questions in one, basically.
Exactly.
And a lot of different terms. I've also heard today very often the term greenwashing. I think the GSS market does not deserve that, to be honest. There might be a few instances of greenwashing here and there, but I think the reality is that it's sometimes just a different level of ambition, and sometimes a different starting point for different countries and different companies. I have to say that I think if you look in general towards financial products, I think, we together, the GSS community, has been building something really unique. There's no other product in the market which is as well defined as GSS bonds at the moment. Because when you look at the asset management side, at other products like sustainable equity, sustainable credits, the number of different definitions behind that is so much more than the GSS market, where I think there's quite a strong consensus on what it is. So I think that's one point to make. Second, I think when we are looking at green, social, and sustainability bonds, we are roughly rejecting 36% of all the labeled bonds coming to the market. But again, we are very strict, and this 36% which we are rejecting is not all greenwashing, not at all. I think it's just probably a lighter version of what we want as an asset manager. So I think very often, it's just about a different level of ambition and a different starting point. Where, in general, are we concerned when we are analyzing labeled bonds is when there's a disconnect between the use of proceeds and the core business of the issuer. I think that's really important for us. So, to give you an example, if a utility company is going to issue a green bond to finance a green building, yes, then you should wonder how credible that is, because you really want to tackle the core of the business and address the long-term issues. So I think that's one topic. I think the second is that sometimes the documentation on the framework can be a little bit different compared to what we're seeing in the final green bond or social bond allocation. So quite often the devil is in the detail. So, when you look at sustainability-linked bonds, for example, sometimes you see issuers having specific targets on CO2 reduction and only focus on scope 1 and 2, and very often scope 3 is the crucial one for some of the companies. So I think those are the two crucial ones for us to be very critical on and to have a look at.
Thank you very much. Please, Christa, and we'll also hear our Julia or Nicole.
Yeah, great. Thanks for kicking that off, Bram. I think your points resonated with me. So we're an SPO provider, and integrity is our main motivator. This is why we're in this space. So from the beginning of the market, back from the first green labeled bond issued by the World Bank, through our former parent foundation, CICERO Climate Research Foundation, we helped establish this independent SPO model that you still see as best practice globally today. And I think that the way that I see it is the independent SPO provider is the first line of defense for maintaining integrity in the market and protecting against greenwashing. It's not the end of the story, but it's the beginning of the story. And so the two things that you laid out, Bram, are things that we take very seriously in our SPOs. First, the level of ambition. And we have a way of illuminating that level of ambition through our Shades of Green methodology, which not only speaks about the dark green, deeper green end of the market, which maybe you see, for example, through the EU taxonomy alignment, but also the really important other environmental steps that are earlier stages in the transition that are relevant in different regional contexts. We've heard a lot of talk about that at various events and today at the ICMA conference. And the second thing you talked about was placing the financing within the context of the issuer. This is also something that we highlight in our SPOs so that we can position a green bond, for example, within a transition financing plan. And I think that's really important, again, for protecting the integrity, so we're not issuing a green bond with one arm and financing fossil fuel with the other, because then actually we've done nothing for the environment in the end.
Very clear, thank you. Maybe on the line, Julie or Nicole, do you want to add something to this?
Julie, do you want to take the floor?
Yes. Well, first of all, I think it has been said, but it's important to underline that greenwashing is a very sensitive and complex topic that covers not only green, but all sustainability factors and efforts. However, it's clearly essential, as Bram just said, not to create green bleaching or green hushing and deter the market. What we see is that there are already some definitions in the market coming either from IOSCO or from the EU taxonomy, referring to misrepresentation or to the notion of gaining an unfair competitive advantage, while the ESAs on their progress report on greenwashing published a few weeks ago refers also to misleading impression due to either the actual provision of information or the omission of this information. And I think as far as exchanges, at least as are concerned, this omission of information is a very important element, which underscores the need for transparency. And the transparency do not only apply to what information is provided to the market, but as well what information is not provided. For instance, whether an issuer has or not published its post-issuance reporting, if the SDGs that they intended to contribute to are effectively reported upon post-issuance, or if amounts issued by the bonds match indeed the amounts allocated to reported projects. So we could speak for very long about the dimension as well of greenwashing, the different roles as the triggers or as the spreaders, as the different sustainability topics it covers, the different shapes as well. So what I think is very, very important is not to be overwhelmed and discouraged in taking the green route, but making sure that all realize at the end on the transparency which is brought to the market.
Thank you.
Can I come in there? So I think if we did a word cloud of today, right, we'd probably see disclosure, probably taxonomy, but greenwashing would be up there. But I'm sure for many of our audience, there is still a huge lack of clarity. And we've talked about that now, and Julie mentioned green bleaching, green hushing, you can add green wishing to it. One of the concerns that I see is unintended consequences by using this term frequently in the market without that clarity. And in fact, tip of the hat to Nicholas and the team at ICMA for trying to provide some definition around it. those unintended consequences may be, a real concern around reputational risk, potential regulatory overreach. Investors may, find it be hesitant in investing in the transition because of concerns over those reputational issues as well. So I think we have to be very responsible, excuse the pun, in how we think about this phrase. And that delineation between intentional misstatement versus perceived lack of ambition as well. And on that front, I'll also say that when we think about ambition, it's not black or white or green and not green. There is nuance, there is differentiation. And again, tip of the hat to Christa and her team for all the work they've done in this area. We also have a 5-point scale at Moody's. We like an alphanumeric scale. We're a credit rating agency, and SQS1's at the top of our scale. And around 10% of all the SPOs that we've covered hit that sort of top of class. You've then got around 2/3 at an SQS2, which is the second level, but then 20% at an SQS3 or an SQS4. What we're essentially saying there is this aligned with 1.5 degrees? Possibly not. But in the sector in which this issuer operates, are they doing what they can do with the best available technology and on a pathway and on a journey to get somewhere? Then they are. And so they're unlikely to score at the highest echelons of our scoring, but we're giving them credit for that. And then just a final point, I think local context also really matters. A diesel bus network in frontier Asia may be a very highly relevant solution for that market if the electricity grid is not where it needs to be, and if there's not mass transportation options. If that's happening in downtown Paris or Madrid, that's a different question, right? So we need to be able to contextualize what are the assets and activities that are being financed without necessarily being overly concerned about this sort of binary idea of greenwashing.
Yeah, I think this market has had a lot of success. Obviously, the volumes speak for themselves. The one reason is that it's built on good foundations of the principles which have guided the market in voluntary disclosure. However, we must remember why this market exists. It's because we want to limit greenhouse gas emissions. And during the time that this market has developed, those emissions have continued to increase. And when we look at the issuers of green bonds, a significant portion of them have continued to increase their emission despite having issued a green bond. So I think this market has developed because it was focusing on how we spend the money, the use of proceeds framework, which has been a good thing because it's easy to verify. Within 1 or 2 years, we know how the capex has been spent. But now we realize that's not enough. We need to focus on the impact, not just the output. The impact is about reducing greenhouse gas emission. And that's where we start to question. We heard earlier this morning an investor saying, well, we are very concerned when an issuer of a green bond is actually continuing to increase their brown activities 4 times more quickly than their green activities. That's a genuine concern. And this is an investor that is an active engager with the corporates, and you are as well, right? But not all the investors are like that. Some investors are just passively following ESG indices that sometimes contain issuers that clearly should not be in that index. We've seen instances where there are some brown activities that are still making their way into ESG indices. That's kind of a misrepresentation for an investor who actually wants to put their money to work into an investment that will reduce greenhouse gas emissions.
I'd have to intervene here that it's also that investor's duty to make his homework. So I think it's not the markets to blame, but it's the responsibility of each and every party. And the notion of greenwashing is now becoming a regulatory notion, and it needs to be very well defined so that people understand their risks and not overstate them and just get paralyzed with this fluffy idea. So the examples you're taking are fully relevant to my opinion, and I'd love to get Nicole's view on it, of course. But they're not talking about greenwashing. They're talking about the rationality and the level of robustness, because it's not an intentional misrepresentation, which is what we're talking about here. So here we're relying on the integrity and the robustness of the way the products are both structured and presented to the market, and the way they're analyzed by investors. At least that's my take. Nicole?
But then regulators are starting to query this notion that the market will sort itself.
Yeah.
Like we heard that there is 140 cases of greenwashing that have been put forward. So there may be instances. And actually one issue as well is that the framework that you mentioned as well is a voluntary framework. It's not in the bond documentation. We had an example here in Singapore where an issuer of an SLB put in their framework that they would change their SPT if there was a change in the perimeter of their activities. Guess what? 12 months after issuing an SLB, they sold their coal asset, shifted their emissions to scope 3, and declared that they would not have to pay their coupon step-up because their SPT is scope 1 and 2 only. And there is no reduction, actually, of the carbon emissions. So there are issues in this market.
Oh, there are.
Just to add, because I fully agree with Orith. I mean, asset managers just have to do their homework. You mentioned also passive management, tracking an ESG index. In my view, that's something you should never do. So I think asset managers have also a responsibility here to also allocate resources to sustainable finance and make this a success. So I think, that's a good point, Orith. I agree with that one.
Nicole, can we hear you on this? Because I think you're the issuer representative around this table with quite some history on the SLB market. Can you give us your view on what just been said?
Yes, frankly speaking, I do agree on the fact that I don't think that this kind of market deserve the greenwashing as a definition. And I do also think that if we look at the overall market, at the end, sustainable finance still represents just 2 to 5% probably of the overall market, and therefore probably we need not just the use of proceeds instruments, but also sustainability and all those kind of instruments that will be able to catalyze funds towards sustainable investments, because this is the final point and final objective that we do have. The important thing is to catalyze funds towards sustainable investments. Yes, we do see some problems on the market, and probably we have also seen as Bram was saying at the beginning, some greenwashing here and there. But I frankly don't think that this is the definition that this market deserve. We do have a lot of standards, and we are increasing more and more disclosure and transparency, and this is thanks to the ICMA principles, first of all, because I think that ICMA principles brought standardization on the market, and we are helping investors and issuers in developing these kind of markets. And now we do have also the EU Sustainable Finance Framework more in general, that it's not just the EU taxonomy, but it's also all about disclosure and transparency. But even there, I think that it's important to have rules, regulation, and procedures that regulate transparency and disclosure, but we do not have to lose then the final objective, because I think that financial markets have a huge responsibility in moving capitals towards sustainable investments, because that's the real point. And I think that we need all the instruments that are working in that respect, both the use of proceeds instruments that, of course, born well ahead with respect to the sustainability-linked bond or sustainability-linked instruments more in general that were born just in 2019, but grown a lot during the last years. And we need, yes, I think that transparency, disclosure, and also standardization are needed to this kind of market, but we have to continue to invest in the developing of these instruments without losing the final objective, that is the one to move capital towards sustainable investments. and therefore the integrity and KPIs that are representative of the core business of the company are, I think, the key lever that we need to focus on. And for sure, data and the reliability of the data that we do see on the market are another key layer, because of course we need assurance and independent reviewers that then certify the reliability of the strategy of the company on the KPI and on the instruments also itself.
Thank you, Nicole. Maybe to most of you as well, if we go just step away from the semantics between greenwashing and integrity and what we just discussed, and get into the content. I've heard from some of you the most of the challenge we're seeing is with regards to the connection between the company strategy and its instruments, its funding instruments, be they use of proceed or linked. It can come from and it can also come from level of ambition, or in the case of SLBs, relevance of the KPIs that are used. Do you have examples beyond the one you've mentioned that really stroke you as, it doesn't have to be named, but just give us some ideas of situations where as an SPO provider, as a market authority, or as an investor or observers, you've been puzzled with the integrity matter in front of you. That's one question, and the other question, which is a bit more generic, I have to say that those debates around integrity and greenwashing have completely changed scale with the SLB. They haven't been created with SLBs, because we had many debates, and I'm sure, Nicole, you remember, on the additionality matter with regards to green bonds, which I believe is a comparable matter. But we changed completely scale with SLB. So I'd love to hear your views on that as well. And you can pick and choose. Maybe yeah, you're interested. You can.
So how can you come up with an ambition level that is low? Well, there are many ways, right? You brand a target that is business as usual for you, but actually you build a story around it. So that's one example. Or you can use also carbon accounting tricks to shift between emissions scope 1, 2, and 3. That's another way. You can also put a call option before your observation date in an SLB, so that you can call the bond if you see that you're not meeting the target. So there are ways that will undermine this market. So we want to fight those examples. And I think it's down to the integrity of the market players, obviously the bankers, the lawyers, the auditors, the accountants, to explain to the issuers, what are these issues, why, they will reflect negatively on the company. And not every issuer is aware of all these examples that may exist in the market. And I think the market is growing, and the knowledge level is increasing, thankfully. And it's still a young market, 2.5, 3 years old. So we still need to learn. And I'm hopeful that this will flush out over time.
Yeah, look, I think if the use of proceeds market is in its teenage years, we're still toddler years, right, for SLBs. Again, we can put some data around this. We can put some quantitative data around this. So of our portfolio at Moody's, around 25% are SLBs or SLLs versus use of proceeds. And the median score is an SQS3, so it's the midpoint in our range. Use of proceeds is one notch higher at an SQS2 at the median. So I think, look, every structure is different, has its own nuance, but that's probably indicative of the relative lack of maturity in that market. What I would say is probably in the last 6 months, we have seen a definitive trend of quality over quantity. Pretty much every framework that I've seen and my team have seen now generally includes some form of scope 3 emissions KPIs within the structures. We were privileged to work with ENEL that included full scope and also innovative targets around EU taxonomy, for instance. So the market is learning. Where I continue to see the challenges is around the credibility of the means for achievement, how that story is being articulated, and really going that layer deeper on things like use of offsets, on the use of renewable energy certificates, for instance, as well. So I think the market is learning very quickly, and I expect to see the SLB market in the next 2 years be very different from the one that we've seen previously.
I love the analogy of the toddler for the SLB market, because I can give both a naughty example and a charming example. So I guess more on the naughty side, or at least it gave us a good laugh. We had a potential client come and say, well, we're going to set up a KPI that is to set up a KPI. I mean, essentially, it was a target to set a target, which if you think about what that might mean for the environment, you have to have a good laugh about that one. So we said, not good enough, sorry. On the other side, we've seen some really good examples too, and the sort of charming example I would share is an SLB that we did the SPO for an aluminum company, and they didn't have good data on Scope 3. Surprise, this is most of the market, right? They didn't even have control over most of their Scope 3 emissions. But rather than excluding that from the KPIs, what they did was use a proxy, which wasn't an emission measurement, but an amount of scrap metal recycled. So it didn't cover all their Scope 3, but we thought this is an innovative approach to raise awareness on Scope 3, watch it over time, have some measure against it without waiting to have the perfect data to move. So I think there's a lot of examples in both different directions, and those were just the two toddler examples I'd share.
Julie, do you have a view on these questions?
Yes, thank you, Orith. Well, I think it's true that SLBs have been much more exposed to greenwashing claims than use of proceeds sustainable instruments. Certainly because of the flexibility of the instruments, because it's rather new, and also because issuers come from all sectors. As it was just said, some examples you asked what type of examples could or have struck us. I'm thinking also about potentially some targets that are already achieved before the SLB is launched. So by ignorance of the issuer sometimes, especially on Scope 3 indeed. But I think what is the most important is not the failure to reach those SPT, but the failure to notify the market. That's where I think the most important is the transparency. Because, failing to reach an SPT could be also seen as that the SPT were ambitious, very ambitious, and ambitious enough so that the issuer was indeed not in a position to reach such an ambitious SPT. We can see it also in a positive way. What is extremely important for me, and especially to come back to what you said about the responsibility of investors, is that investors then need to access important information and full transparent notification of when and where and why an SPT is not met or reached by the issuer. But I would like also to take the opportunity, speaking about SLBs and the risks around the integrity of SLBs, also to underline the importance of those innovative instruments to finance the just transition. I think it's extremely important. We are in 2023, halfway to 2030, and we really, really need to accelerate the financing of the transition, and especially in high-emitting sectors, because it's the transformation of these sectors that will clearly determine the world's ability to reach net zero emissions. And that's where SLBs really hold the key.
Maybe Nicole, a word on this if you wish. You clearly have made a choice at ENEL Group to position yourselves or to shift from green bond issuance to SLB issuance. What's your take on the little competition and when it comes to integrity, which I don't believe is extremely relevant, but does exist, what's your approach to protect both the ambition, the integrity, and the transparency of your issuances in SLB format?
But back to the level of ambition, I think that the level of ambition is strictly linked to the corporate strategy and not just to the instrument itself. And that's what we have done as ENEL as a choice. We have decided to move from the green bond market to the SLB market just because from the business standpoint, we decided to switch from a much more thermal business back in 2014 towards a much more renewable business, and now we are kind of a major in renewable business. And we just realized at a certain point in time that our business was mature enough to switch towards an holistic view of the strategy itself. But back to what we were saying before, and also to what Julie was saying, I don't think that it's, let's say, a big problem if we do see a corporate breaching an SPT, or because it's the level of ambition that we are analyzing, and we can see and we can say, okay, that corporate put the level of ambition high enough, and they work in reaching that kind of KPI or target, but there is still some work to do in that respect. It's embedded in the instruments, I would say, because once again, it's not the instrument per se, but it's the strategy that drive everything. And the history in delivering what a corporate is saying when it comes to the strategy is the important thing. It's really about the holistic view, and to move towards from probably a much more use of proceeds and project specific view towards a much towards the KPIs and therefore the holistic view and strategic view that the corporate might have. Of course, in that respect, the KPI is key, and we have to work a lot on the standardization and disclosure of the KPIs that can be used by a wider, broadly by a lot of corporates. So the focus move towards not just the project, but the KPIs and how corporates define the KPI, and once again the strategy. Because when it comes to sustainability and embedding sustainability in our business, it's not the short term that we need to see, or just the short term, but it's also the medium to long term, because sustainability needs time, and therefore we need to have corporates with a reliable strategy in the medium to long term when it comes to the decarbonization plan and decarbonization path. I think that the aim of the sustainability linked instruments is this one. And as I was saying before, and as also Julie was underlying, we need all the instruments to really move towards the decarbonization and to reach the target that the Paris Agreement has set. So I think that both use of proceeds instruments and sustainability linked instruments need to be developed in order to reach the target that we do have. That is the one that has been set in Paris and with the Paris Agreement. So that's really the point. For sure, we do have a lot of work to do, and for sure, sustainability linked instruments are probably behind in that respect to use of proceeds instruments, just because they are quite new with respect to the use of proceeds instruments, and we do have to face different probably issues much more related to strategy, to reliable strategy and to KPIs, but working on KPIs and standardization of KPIs and quality of data and information, I think that it's key to have also those kind of instruments that can be used, by the way, also by those corporates that are not CapEx intensive, for example, that can be used to finance the transition, and that can complement the use of proceeds instruments in the right way.
Thank you very much. Go ahead.
Yeah. Just to make a couple of comments on the SLB market. You know, I feel a little bit, and I don't know if you agree, Orith, or any of the others, that really, you know, something has to happen with the SLB market in a positive way. It's too unclearly defined. I fear a little bit if we don't push it harder to define what it really is, maybe 5 years from now there will be no SLB market at all. I think when you look at the labeled bond market this year, we see a record year in terms of green bond issuance, but SLBs are really slumping. It's falling back quite significant compared to last year. Also, let's face it, the financial sector is not participating. They can't issue SLBs at the moment. European banks are not allowed to issue SLBs as a capital instrument because the coupon has to be stable. So a very big sector is missing. So I think we really have to step up. And I think we all agree, we like the concept, you know, linking a coupon to specific KPIs. It makes a lot of sense. But really how to make it work, I think that's just a question which we have not found a good answer for at the moment. So I think that's one part we really have to push up. I think the second, when I talk to clients, I think for our green social and impact bond strategy at GSAM, we have around $9 billion in dedicated strategies. I think we have maybe 150 to 200 clients behind it. When I talk to clients, they do understand and like the use of proceeds concept. You issue a bond, you have your money, you finance a project, you can almost touch it. With SLBs, the end client, asset owners, they are less sophisticated, let's not forget that. They are struggling to understand the concept. It is a complex instrument. And I think that's also one of the big differentiators at the moment. And that's also why we at the moment, within GSAM, have only included labeled bonds in our sustainable investment definition and have left SLBs out at the moment because it's just too loose and too difficult to explain to the outside world what it really is. So I think we must realize that specifically for SLBs, we have a lot of challenges ahead.
If I can add to that, the opportunity we see in the SLB market is that the step-up coupon represents an option value that can be monetized by issuer by getting a lower cost of financing before the observation date. But for that to happen, the target must be ambitious. And unfortunately, what we've seen is unambitious targets, and therefore this option value doesn't exist. But you can conceptually see an SLB as an opportunity to put the lower cost of financing for those issuers that have ambitious targets. And that's something that the use of proceeds instrument don't have. We've talked about greenium at closing, up to 5 basis points, we were told this morning, but that's not sufficient to drive a market. So we have done a little bit of research, and we are thinking that having at least $1 value out of $100 of capital, of option value, would make sense for this market to really be a credible instrument to finance, in particular, the transition. So that's a concept we have discussed with a few investors and bankers, and it seems to be something that could potentially be an option.
That's joining one of the questions we're having from some of our participants on the line. To what extent the challenges we're hearing and the controversy are related to the magnitude of the impact? Because if I may just, I feel the urge to defend a bit the SLB product right now. The notion of alignment with the strategy of the company is probably by nature embedded into the SLB, much more than it is in the use of proceeds instruments. And my personal opinion is that the utmost demonstration is the combination of both the use of proceeds and a KPI-linked and sustainability-linked instrument, because sustainability-linked instruments provide forward-looking perspective. And with your comments on the loose definition, that brings me into a lot of the debates we're having as part of the sustainability-linked bond principle working group, which definitely are trying to answer to all of those questions, and have done a lot of work this year to help the market answer all of these questions that I concur needs answer for. But coming back to your comment and the questions I'm seeing, do we have an issue with the magnitude of the impact, of the coupon impact? Do we believe that it's not of a sufficient stake for issuers? and that is maybe one of the reasons why it's less obvious.
So
in terms of
if you
integrity.
have a very low coupon step-up, or if the coupon step-up is delayed until the final years of the SLB, or if the target is considered as business as usual, the investor will not believe that there is value for them. However, if the issuer is putting a target which is ambitious, where there's sufficient time where this coupon step-up would actually kick in, then there is value for the investor. And an investor would be willing to accept a lower cost of financing if they potentially are more likely to get that coupon step-up. And that's the opportunity. Whereas, unfortunately, the risk right now from an issuer's perspective is, if I don't meet my target, there are reputational risks for me. And that's not what we want to see. We want ambitious targets with a potentially high probability that the coupon step-up will kick in.
Yeah, I think maybe one issue or one possibility to solve all this is let's get rid of the step-up coupon, but let's go to a step-down coupon. So, and I think that's a much more positive approach to build. I see you looking and your eyes almost falling out of your head, but I really think it's a much more...
I love it that it's you saying this.
I think it's a much more positive approach, right? Because why would you punish companies if they're not, reaching certain ESG targets? Let's reward companies if they reach certain targets. So you're not going to reward them in advance, but only if they reach something. I'm really happy to hear from ENEL what their view on that is, but I would say that is a much more positive approach. And then, there's only upside for the company. So, I think that maybe potentially could, fuel or push issuers to set much more ambitious targets.
Okay.
Can I share maybe a slightly different perspective? So, putting my credit rating agency hat on, right? So if that link with materiality is massive, right? So if we're truly saying that whatever the target and the embedded strategy of that company is material to its future business model, to its balance sheet, failure to act will impact its access and cost of capital. So when I look at the work that not just us, but many of our peers are doing in the credit rating space to more systematically and transparently articulate how ESG is impacting credit ratings, I can tell you, for instance, that we have identified 17% of our portfolio in Asia that has elevated credit risk exposure from carbon transition. And if we're not seeing very detailed, credible, and authentic plans, I say authentic because we talk a lot about ambition, but authenticity is also about not expecting scalable green hydrogen in 2-3 years, right? We also have to balance ambition with pragmatism. But if those plans aren't detailed, there isn't a strategy from the issuer to talk about how they're going to respond to that, what this means for CapEx, how they're going to finance that, and what that means for their leverage and their interest coverage metrics, all the good stuff, then that's going to have an impact on their credit rating as well. And so I think there's also the connection between credit risk and sustainability, and that's something that obviously as a credit rating agency we're very mindful of.
Maybe because I'm being conscious of time, I would love to hear some of you on the unspoken but obvious topic here, which is another expression of what we've heard all day, which is the notion of transition. Because around all of these notions, all of these discussions, very often this is what we're talking about. And do we? I'd love to have your views around this panel on what is it that we need, to your opinion, because I hear there are many views on what is this market needing with regards to defining, demonstrating, committing to the right level of transition and the right pace, more importantly, of transition. So if you can share your views on it, because we only have a few minutes, I'll just push my last question, which is also has been asked in the Q&A, which is what can regulation do to help the integrity of that market? And by regulation, I mean regulators, official market authorities, and existing SFDR, green bond standard type of regulation we've seen. So You can choose the different questions.
Okay, so I'm happy to very quickly answer the question about the transition. You know, I think we as asset managers, I think we also have a role to play here. I've heard the term transition today a lot, and I think that's something which asset managers also should try to facilitate, specifically for emerging markets. That's really crucial. I think we must realize that emerging markets, they are behind, they are less wealthy, so they will be slower by definition compared to developed markets. So I think from an asset management point of view, one of the things at GSAM which we have decided to do is, we have our developed market GSS framework where we, do our filtering, etc. But we have decided to have a little bit a lighter approach for emerging markets to facilitate this transition, because I think this is in the end where we probably can gain the most in terms of, reducing carbon emission, etc.
In Asia, there is a lot of work going on around the early retirement of coal power. And it's a very complex topic because obviously there's legacy systems that need to be shut down and then renewable energy that needs to be coming in to replace it. The idea of bringing more blended finance solutions has been offered as a way forward. But it's complex. It's complex because there are, political choices as well that need to be made, and hopefully, there will be some pilot transactions. Maybe following on what ENEL and others have been doing in this market, leading the way from the developed market. But clearly, this needs to be a focus because a lot of those emissions are coming from this energy system.
Yeah, I definitely agree with that. I think I had the opportunity to work on the IPCC mitigation assessment report, and the very clear findings from that, which I don't think are a surprise to anyone in this room, is there's a very intense climate finance gap, and it is the most felt in developing countries. And it is even more apparent when we talk about adaptation costs. So if I just have to put my researcher hat on here for a second, because we are talking about transition, but at the same time, sorry for the depressing news, we've already locked emissions into the atmosphere that we will see the physical impacts of for the next 10, 15 years. So we need to transition so that in the longer term, we don't see as many physical impacts like heat stress, like extreme precipitation, typhoons, et cetera, that are increasing in order of frequency and magnitude across all climate scenarios, frankly, for the IPCC. So we need, when I think about transition and we talk about sustainable transition, I'd also like to bake in that idea of resilience for infrastructure. So I know we've talked a lot about coal and sunsetting and the energy side of the transition, but at the same time, we need to be building resiliency. And I think these concepts are really important and embedded in how we've developed the Shades of Green methodology. And so when we talk about different starting points in different countries, in different regions, with different companies, the point is we need to start. And then we need to follow up over time and make sure that we're moving in a greener direction. And so some of the things that I've been hearing both in Europe and in Asia in the last few days is a little bit of trepidation about the word transition. There's some companies that don't want to be labeled transition. Some companies don't want a transition labeled bond. Of course, this depends on which country you're in. Maybe it's a little bit different. But we need to find that balance between supporting this very needed transition from an environmental perspective, but also giving enough comfort to investors that we can draw this capital where it's desperately needed.
I can take the regulation question if you like, but I'll be very brief. I know we're running out of time. So at Moody's, we have an SBO business within the credit rating agency. So it's a very unique position of having today an unregulated product within a highly regulated entity. We welcome more standards, more procedures in this space, right? We want transparency of approaches. We want good standards around conflict management, around all of those other elements. We think that's essentially just good hygiene in this space. When I think about the EU Green Bond Standard in particular and the use of taxonomy, so we're already providing adherences to the EU taxonomy. Issuers are really, and we talked about this earlier, wrestling with do no significant harm. So we do need to make that more pragmatic and more practical for issuers to really digest and then incorporate into their frameworks. And the final point I'll mention is on the EU GBS. I personally don't want to get to a market that is just an audit, yes or no. We talked earlier, yeah, there is nuance between green and non-green, and there has to be space for opinion, for insight, for nuance, because I think, and Bram, I'm not sure what your view is here, that's what investors are looking for. They're not looking for a check the box, they're looking for opinion and insight. Every transaction has strengths and weaknesses, and we need to be able to contextualize that and articulate that. So hopefully there continues to be space for an opinion-led approach as well.
Maybe Julie and Nicole, if you want to have the last words on these matters. Julie,
Yeah.
on the role, or Nicole, on the role of public authorities, be them regulators or market authorities.
Okay, thank you. Maybe a quick touch base on what you were saying before, just to answer also to Bram on the step up, step down. Frankly speaking, back in 2019, when we kind of invented the SLB, the idea, we didn't invent the wheel at the end, but we just took the idea from the sustainability linked loan markets, and in the sustainability linked loan market we do have a step up and step down, but it seems that at least at that time investors did not appreciate the step down because of constraints in potentially insert these kind of instruments in their portfolio. But we're not against the step down, given the fact that the feedback that we gather weren't so constructive and positive on the step down. We then move towards just the step up. Fully agree on the recognition, and the idea is exactly what has been said before. So there is sustainability means value, and therefore if we will be able to demonstrate that there is value in sustainability, and therefore cash flow more resilient and stable coming from sustainable business, the company deserve a lower cost of debt. So yes, behind sustainability linked bond, there is the link between the cost of debt of the company and the strategy of the company. And finally, on the credit rating, I fully agree on the fact that when we will have credit rating agencies embedding in their credit risk profile, also the ESG evaluation, quantitative ESG evaluation, probably there will be no need to have label instruments, sustainable finance label instruments, because at the end it's all embedded in the risk of the company. When it comes to the regulation, I think that we do have a different starting point, and regulation should consider the different starting point, because of course developing countries are not at the same level as emerging markets, and of course we need also to consider that when we ask some effort to those companies that operate within emerging markets. I think that in that respect, the external assurance and the external provider can really help in even create probably standardization of the market and what it's needed and what it's not needed. EU is doing a huge work in that respect with the EU Sustainable Finance Framework. Even there, we need to pay attention not to over-regulated than the market, because the EU Sustainable Finance Framework is mainly based in Europe, but the sustainable finance market and financial market, when it's more in general, it's not just Europe, and we do have the overall fixed income market that need to be considered and taken into account, because otherwise the risk is that we in Europe, and I think that sustainable finance is born in Europe, and we are really ahead to a certain extent with respect to the other markets, but we need also to pay attention really not to over-regulate it, because the risk is that we then remain behind instead of moving forward.
Thank you, Nicole. And maybe the last word for you, Julie, before I'm getting the mic cut off. If you can just share with us your views on what tools and we're still missing, and what role for the regulators.
Thank you very much, Orith. I think regulation is absolutely key. It was just mentioned about EU GBS and even maybe more crucially, the EU taxonomy is absolutely crucial, especially, well, I think the demand as well for EU taxonomy and EU GBS aligned product is likely to increase clearly in the future due to the reporting obligations that apply to asset managers and to investors. And clearly to further strengthen credibility in the market, I think it will be very important that issuers produce detailed disclosures at bond level and even beyond green bonds. I think that issuers of SLBs as well could also seize the opportunity to embrace the EU taxonomy. On the role of the regulators and market operators, and as far as exchanges are concerned, I think our role beyond, of course, our role in terms of conditioning access to market financing by establishing listing requirements. We also have a role to play in bringing trust and confidence in the market by educating the market and by giving access to meaningful and usable data so that investors can make informed investment decisions, and we can address, thanks to transparency and trust, also the greenwashing issues we were discussing today.
Thank you very much. There were a million other topics we would have wanted to address. We did prepare at least as many questions as the ones we managed to address. Thank you very much. If I'm allowed for an ICMA page of advertising, a lot of the questions and requested guidance that have been mentioned are or will be addressed as part of the work from the various working groups and the Q&As. So I'll invite you to have a look at the work that's been produced or will be published by the end as soon as possible. So the ICMA working group are working super hard on providing that guidance to protect that integrity.